If you're buying a home, one of the most important documents you'll receive is called a loan estimate, or LE for short. The good news? Every lender is required by law to give you the exact same 3-page form. That means you can compare apples to apples. In this video, I'll walk you through exactly what's on each page, what the numbers really mean, and the key things to watch when you're shopping multiple lenders. Page 1 is your at-a-glance summary. At the top, you'll see the basics: who the borrower is, the property address, the sale price, and the loan term. In this sample, 30 years. Right below that is the loan terms box. This is critical. It tells you the loan amount, $162,000, your interest rate, 3.875%, and the monthly principal and interest payment, $761.78. Notice the column to the right asks, can this amount increase after closing? For a fixed-rate loan, all three should say no. Then check for special features. In this example, there's a prepayment penalty. If you pay off the loan in the first 2 years, you could owe up to $3,240. There's no balloon payment here, which is good. A balloon payment would mean a large lump sum is due at the end. Next is projected payments. This shows your full monthly payment over time, including principal and interest, mortgage insurance, and escrow. In this case, the total is about $1,050 for years 1 to 7, then drops to $968 once mortgage insurance falls off. Finally, at the bottom, look at costs at closing. Total closing costs of $8,054 and estimated cash to close of $16,000. These two numbers are where lenders can really differ. Page 2 is where the closing costs get itemized. There are two main buckets. Loan costs, sections A, B, C. Section A is origination charges. This includes points that could make a difference between lender to lender, but the lender fees, like the underwriting fee, are more or less the same. Section B covers things you can't shop around for, like the appraisal and credit report, which is also same across lenders. Section C is the big one, services you can shop for. These are all small fees except the lender's title policy, and this is mandated by the lender, unlike title insurance, settlement agents, and title search. In this sample, that's over $3,000. Getting competing quotes on these alone can save you hundreds. Other costs, sections E through H. This covers government recording fees, prepaid interest, homeowners insurance premiums, and your initial escrow deposit. These are mostly fixed, but prepaid interest depends on your closing date. Closing later in the month means you prepay less, and as well, these are prorated interest and can vary a little from lender to lender. Section H, Other, Owner Title Policy. As lender's title policy costs you $535, which makes sure that if there is a problem with the title in the future, the lender stands to get back his money that he has given as loan. However, the down payment can never come back to you, as that is not insured, but this owner title policy makes sure that your down payment as well comes back to you. Lender's credit. Sometimes the lenders run a promotion and can be counted for comparing lenders, as this could help you reduce the closing cost as you will get a discount. At the bottom is the Calculating Cash to Close table. This reconciles your down payment, deposit already paid, and any seller credits to arrive at what you actually bring to the closing table. These are the estimated closing cost. The actual cost might change a little. Page 3 is where you find the numbers that let you compare loans head to head. The comparison section has 3 powerful figures. First, 5-year cost. In this case, $56,582 total, paid, with $15,773 going toward principal. Second, the APR at 4.274%. This is higher than the 3.875% interest rate because it folds in fees and costs. Wondering how? The APR is the truest measure of a loan's cost. The interest rate on this loan is 3.875%, but the APR shown is 4.274%. So where did that extra 0.4% come from? Let me explain. The interest rate only tells you the cost of borrowing the money itself. But getting a mortgage isn't free. You pay origination fees, underwriting fees, appraisal fees, title costs, and prepaid interest just to get the loan. The APR takes all of those upfront costs, folds them in, and expresses your true all-in cost as a single annual percentage. It's always higher than the interest rate, and that gap is entirely explained by fees. Here's the practical insight. The bigger your loan, the smaller that APR gap will be, because the same dollar amount of fees is a smaller percentage of a larger loan. Third, the total interest percentage, or TIP, of 69.45%. That tells you over 30 years, you'll pay nearly 70% of your loan amount in interest alone. Also note whether the lender intends to transfer loan servicing. In this sample, they do, meaning someone else may be collecting your payments after closing. And one important note on the signature line at the bottom. Signing this form only confirms you received it. You are not committed to taking the loan. The loan estimate is designed to protect you. Use it. Request one from every lender you're considering, and don't be shy about asking a lender to match or beat a competitor's numbers. You have 3 business days after applying to receive this form. Keep them, compare them side by side, and save this video if you need a refresher. Good luck with your home purchase. Contact TAM Mortgage today.